Okay. Take 3. The first one messed up too, right? I messed it up a little bit too. Alright, I had a little issue with I had something playing on my PC that I couldn't hear when it was going into the stream, so I apologize for that. We're going to try it again. Yeah, so let's start off with the devotion to get us going right. So chapter 11 we're going to discuss today. We're going to go over the little bit of the slideshow, discuss the topics. Might even do some of the... I might just do it all today, to be honest. I'm not sure, because I might just make it one longer stream and go ahead and do the... there's only 5 quick study questions, so maybe we'll just knock it all off today. Knock it all out today, I should say. Let's start off, though, with our devotion, which is relevant because yesterday when I was watching my streaming service, we actually had a discussion of doubting Thomas, which was pretty interesting. That this coincides with it. So this is from Don Davison down in Texas. He wrote this devotion for us. It says, you may be familiar with the story of Thomas. He missed seeing the risen Christ when he first appeared to his disciples and would not believe in Jesus' resurrection until he could see it for himself. Of course, Jesus came and then Thomas believed, but have you ever noticed how much time passed between those two appearances? It was a week. For a whole week, Thomas had to listen to other disciples talk about Jesus' resurrection, and each day passed with no sign of him. Thomas must have been thinking, I'm too clever and level-headed to fall for that. Then Jesus came, and Thomas was completely humbled. Discovering we are wrong is humbling to be sure. When we are humiliated, when we are humbled, not humiliated, but when we are humbled, the barriers between us and God fall. Ultimately, it is our own arrogance that separates us from God, arrogance that leads us to our own rules, going our own way, and refusing to submit to God. So wouldn't it be better to stop trying to be right and just go with God? So that's from Don down in Texas, a little thing about humbling, and also our disciple doubting Thomas there. So, let's talk about current liabilities and payroll accounting. So, the gist of what we want from Chapter 11 are 2 things. Well, really 3 things. We're going to talk about interest again, which we talked about interest in the accounts receivable chapter, which was 9. So, we'll do a little more of that again. But the majority of this chapter is current liabilities. The 2 we're going to focus on is payroll liabilities and sales tax liability, okay? So, let's look at our slideshow. I had to sneeze. Current liabilities, payroll accounting, okay? So, we got 3 elements that are needed for liability to exist. This is actually your first question of the week. Your first questions of the week is to list the 3 elements of liabilities. The first one is their result. These liabilities are a result of a past transaction or event. Okay, and the second thing is that they represent a present obligation. In other words, they are due in less than a year. Okay, current obligation. They're due in the near term, not in the long term. Okay, well, I don't want to go too far, but we're talking about current year for the most part. And then the third one down there is they will result in a future payment of assets, usually cash, or services if it's some sort of an unearned revenue situation. Okay. So the 3 elements of liabilities, that's your first question of the week. Okay. List the 3 elements of liabilities, and that's them right there. Nice and easy. Okay, so from this list, we're going to focus most of our time on sales tax payable, which is going to be in the quick study and homework, and then also payroll liabilities, which will be on this slideshow. Okay, so let's think about payroll liabilities first. All right, so I've got my little Excel down here. So if I worked 30 hours for a week, or maybe 2 weeks, whatever it is, part-time job, maybe it's 2 weeks, and I'm getting paid $10 an hour. Okay, how much should I get paid? Well, that's easy math. Okay, you'll just multiply them together. 30 hours times $10 an hour. Well, I should get paid $300, and that's actually called gross pay. That's how much you actually earned. Okay, Now, we all know, unless you're working some sort of under-the-table job, you're not going to get $30 an hour. Okay, you're going to get, $300. You're going to get something less than that, maybe $242.67, where there's a discrepancy. Well, where did all that money go? Okay, and that's the gist of this chapter, is kind of learn a little bit of why am I not getting paid 30 times 10 or $300. This picture, even though it's a little blurry, it was a low-res picture that I expanded, so that's why it's a little blurry. This picture is going to try to explain it, okay? And what you've got here, this is that gross pay. So this is that $300 right here. And then down here, the net pay is going to be the $300 minus all these things. 5 things. What? 5 things, really? Okay. And that's going to represent that difference between the $300 and maybe that $242.67. So the first thing is federal income tax. Whenever you start a job, you fill out a form called a W-9, okay? That W-9 is going to say, it's asking you what your tax status is. Are you single? Are you married? Do you want to claim yourself as an exemption? Do you want to claim you and your spouse as an exemption? If you have children, do you want to do married with, if you got 4 kids, well, that's a lot, right? But if you were married with 4 kids, then you can do 6 exemptions. That'll be 1 for you, 1 for your wife, and 1 for each kid, okay? And all that's going to tie into how much they take out of your check for federal income tax. It's an estimate, okay? They're going to pull it out. They're going to send it to D.C., and then when you file your tax return, if you paid in too much, they'll give you a refund. If you didn't pay enough, you'll have to pay some money in then, all right? So federal income tax is the first thing. It's based off of that W-9, okay? And if you kind of go by the rules, like your first job out of college, if you do your W-9, if you're single 1, in other words, I'm single and I'm my own exemption, which most of you will be, then ultimately you'll probably get very small, either you're going to get a very small refund or you make to pay in a very small amount. Okay, when I first did it way back when, I think I had to pay into the government like $100, and I received a refund from South Carolina of about $150. So it kind of all ended up working out because I chose single with 1 exemption. Now, if you want a big refund in the spring, okay, some people like to do that, even though technically it's not a good idea because you're giving the government a free, interest-free loan. Then you do single 0, and it's where you hear all these people talking about there's these giant refunds they're getting. It's because they paid too much in, okay? They're just getting back their own money for the most part. Anyway, so that's federal income tax. That's the first thing that's going to come out off the top of your check, okay? And we'll do an example here in a minute. Now, the second thing is the state income tax. Okay, so for South Carolina, I think the tax rate, the income tax is about 7%. So about 7% rate in South Carolina. Now, there's some states like Texas and Florida, 0. There's 0 in state income tax. So there'll be 0 here for those states. Now, they make up for that with higher sales taxes, maybe higher property taxes too. But there are some states that you can live in that have 0 state income tax. That's one reason, other than the weather, that a lot of older retirees like to move to Florida because there's no state income tax. Okay, voluntary deductions. Okay, if you do health insurance, dental insurance, maybe you just want to give some money to Red Cross or something like that straight out of your paycheck. Some of that can be in here as well. So these voluntary deductions come in here. Now, some of this is not so voluntary. Like you got to have health care, and your work might pay half, or they might pay 90% of it. You might pay a little bit of it too, so that would be in this area. Sometimes you'll get paid. They'll pay you. They'll give you your health insurance, but if you want vision and dental, then you have to voluntarily pay those yourself, and that would fall in that category there. And then these last two here, FICA taxes, okay, FICA. We'll go over to what that means in just a second. Medicare and Social Security. Okay, now those two, the A at the end stands for Act, so they're a result of legislation, and we'll discuss those shortly. Okay, it's on the next slide. All right, so here is FICA. So FICA, whenever it came up back in the 40s or whenever it was, it stands for the Federal Insurance Contributions Act. Okay, FICA. Okay, it's essentially what it is. You're supposed to you pay in these taxes. Okay, I pay in for Social Security. I pay in for Medicare. That way, when I'm old and retired, I'll get paid from Social Security, and I'll be covered. My medical expenses will be covered by Medicare. That's the theory behind it. Okay, now look at these rates. They don't really make a huge amount of sense in terms of the numbers. The combined number is 15.3%. Okay, which is these two added together. But what you see here is half is paid by the employee, the other half is paid by the employer. Okay, so of this 12.4% for Social Security, half will come from my money. Okay, the other half will come from the employer. Okay, we'll go over it in a second. And then down here for Medicare, okay, half, 1.45%, is paid by me, while the other half, 1.45%, is paid by my employer. Now, there are a couple rules here. Social Security only applies to the first $118,500. This does change from year to year, this number here. But once you make past that amount, there's no Social Security tax on it. Then down here, if you make too much, then you have to pay a little bit of additional Medicare tax, a small amount. All right. There's also these apply to the employers. Okay, we'll go over it in a little bit. Federal Unemployment Tax Act. Okay, FUTA, and then SUTA. Okay, State Unemployment Tax Act, paid by employers. All right, so let's go back to our Excel here for a minute. All right, so let's bring this $300 down here. This is my gross pay. Okay, let's say when I filled out my W-9, we figured out that from each paycheck, $25 is going to go to pay my annual income tax payment. So we'll say this is federal income tax withholdings. Okay, we'll say it's $25. So what's going to happen is the employer is going to take $25 out of my check, and they're going to hold it. It's going to be a liability to my employer. They can't spend it because they got to send it to Washington, D.C., or to where the Treasury is, like, you know, for me to get credit for it on my taxes. So it's a liability to my employer because they got to send it to pay my taxes. Okay, and then we'll say that the state income tax withholdings, I think it's two H's, is going to be, we'll say $15. Okay, so they're going to take $15 out of my check, and they're going to send it to Columbia, if you live in South Carolina, you know, down to the state capital, so that they can use it to, I can use it to pay my state taxes when I do my state tax return next spring. Okay? We will say, you know, voluntary withholdings, maybe vision, maybe dental, maybe some sort of charity you want to take out. We're going to do 0 for this for right now. You may get some of those whenever you start working. You may not. It'd be your choice. Maybe you have a thing where you can donate, you know, $5 per paycheck to Red Cross. Okay, you would do that there if you wanted to, and that would be a subtraction. And now let's get to our. Okay, let's do Social Security. Okay, now Social Security is math. Okay, there's no $25, there's no $15. Remember, my portion is 6.2%. Okay, so what I would do is I would multiply my gross pay times 0.062, right? And so $18.60 will have to get paid to Social Security. Okay, and then we got Medicare. Let me put the percentages over here in the numbers here. Okay, 6.2%. And Medicare, 1.45%. Okay, so here, again, it's just straight math. 300 times 0.0145. Okay, so these numbers here are withholdings that are coming out of my paycheck. They're liabilities to my employer because they have to hold them and send them to the proper place, and they do that at the end of each quarter. At the end of the quarter, they'll do some tax returns for payroll taxes, and they'll send the money to the governments. Okay? Let's figure out what my net pay is. That's going to be this, 300 minus the sum of my withholdings, right? So there we go. This would be my net pay. And so I was a little more than I said, right? I said, what, 242.67? Okay, 237.05. Okay, so that's based off of... Now, these two numbers here are coming from some estimations or some W-9 form. Okay, the W-9 form will kind of get those for us. I just guessed them at 25 and 15. That might be too much or too little. But down here, these are straight, calculations based on the percentages. We pay half as employees, so if I make $300, I have to pay in to Social Security $18.60 and $4.35 to Medicare. Okay. Now, so if I make $300, my check that I'll get will be $237.05. Okay. What else do we have on the slideshow? That's it. Okay, that's it. All right, now, let's look at these real quick. 6.6%. Now look at this. Look at these numbers, though. Why? Where's my? There we go. I must have closed it. Anyway, look at the difference here. So there's only 0.6%. 0.6. That's federal unemployment tax. So it's very, very little, right? Where it's a whole 5.4%, a lot from the state. This is essentially it's intentional. The federal government wants the states to handle unemployment taxes. Okay. A lot of this right now is big in the news because of the coronavirus. Okay, so. State unemployment taxes is a big deal right now. Federal is too. But this is paid by the employer. Okay? And it's these percentages. So let's go back to our slideshow. Not our slideshow, but our little doodad here. So in this situation, okay, we had $300 worth of... salaries, we call it salaries earned by employees. Probably should have capitalized that E, but I'm not going to fix it. Actually, I can't see it. I got to fix it. That looks so much better. Anyway, so if we have $300 worth of salaries earned by employees, and we're the company paying these salaries, we have to spend some more money. It's more than just $300 to us. Okay, yeah, we got to give them this, but we also have to pay the other side of Social Security, the other side of Medicare. We also are responsible for FUTA and SUTA. Okay, So in this case, these are going to be actual amounts based on the percentages, okay? So we're going to have to do Social Security at 6.2%. We're going to have to do Medicare at 1.45%. We're going to do federal unemployment taxes. And that's going to be, what was it? 0.6%. It's on that slide. You can go back and look at it. And then we got state unemployment tax, 5.4%. Okay? That's right here on this slide. Federal is 0.6, state 5.4. So, what we'll have here is this $300, I can use this run right here, times 0.062. It's the same number because remember, the employee pays half, which is you see over here, and then the employer pays the other half, which is right here. Okay? Then Medicare, $300 times 0.0145. Same number, $4.35. Now we got our federal unemployment, which will be $300 times make sure this is 0.006. Okay, $1.80. And then finally, we have $300 times 0.054. Okay. So, these four numbers combined, this $40 is additional payroll tax expense for the employer. Okay? All right. So, this $300 is salary expense for the employee for the employer. The $40 is additional payroll tax expense, okay, for these taxes that the employer has to pay, half of Medicare, half of Social Security, and then the unemployment taxes, federal and state. So, as a whole, this $300 amount earned by the employee will cost the employer $300 plus $40.95 more. Okay? It'll be in two different expense accounts, and we'll see it here shortly. Let's do this. Quick Study, Chapter 11. Five questions. All right. Question number 1. Which of the following is normally classified as current liabilities if we have a 1-year operating cycle? Okay, most operating cycles are 1 year anyway. So, of these first 4, the ones that are due in less than a year are current. So this one would be current, 10 months, and the 11 months one. These other two are not, they're long term, right? So they would not be current. Then down here, salaries and FICA are always current liabilities. There's number 1. Well, I don't have a check my works here. What the heck? This one's got check my works. That's fine. Now, this one's different, okay? This one's different. This is going to be some sales tax. I didn't do it before. We'll use Excel now to help explain it. Okay? Make it a new tab. Make the view. zoom up to 200% so you can see it better on your screen. Lovely. And back to, I can close this one, can I? There we go. That makes it a little bit easier. Delta Computing sells merchandise for $6,000 cash. There's a 5% sales tax. Okay? So we should know if we're going to spend, that's a lot of money for us, right? $6,000. But if we're going to spend $6,000, let's just make it currency. We're going to spend $6,000, and this is the amount of sale. Okay, and the sales tax rate is 5%, right? We just said it, 5%. Let's convert this to make it look fancy. Percentage. Okay. So how much sales tax needs to be collected? Okay. So the amount of sales tax from this sale, okay, will be easy math of $6,000 times 5%, $300. So this is the amount that needs to be collected from the customer to pay sales tax. Right? It makes sense, doesn't it? Should. Let's do a thick underline there so you can see it. Good. So, because we got to spend we have to send $300 to pay the sales tax. We don't take $6,000 from that customer. We have to take $6,000 plus the sales tax, right? So the customer will have to pay $6,000 plus $300. They need to pay us $6,300. $6,000 of it is sales. $300 is sales taxes that we need to pay to the government. Think about that, okay? So let's come through this entry. Let's look at this entry real quick. How much cash do we need to collect? We just discussed it, $6,300. The amount of the sale plus the amount of sales tax. Okay? Well, the amount of the sale, well, that was $6,000, right? Leaving $300. Now, what is this going to be? Sales tax expense? I only got salaries, expense, and taxes payable, so it must be this payable thing. Well, how does that work? Well, it makes good sense, actually, okay? This is not an expense for us. This $300 is not an expense for the business. It is a liability. We owe it. Now that we've collected it from the customer, we have to hold it, and then we have to transmit it to the government. We are responsible to send it to the government at a later date. Usually it's at the end of every quarter. You'll do a sales tax return, and you got to send this huge amount of money to the state, okay? But you've collected it from customers, so it's not even our money. So this $300 that comes in from the customer, even though we're holding it, it belongs to the government, okay? And that's how that entry is going to look, okay? So there's the cash we collect. There's the amount of sales. Okay, and then here we got the remittance or the collection. This $300 that we have in our bank account, it doesn't belong to us. It belongs to the government, so it's a liability. Okay, we don't want to spend it because we got to spend it later. We got to send it off later. Okay, second thing is, okay, record the cost of sales. We've done this a bunch of times this semester. Okay, remember, it gives us the cost of sales here of $3,900. So we got to put that into cost of goods sold and take it out of inventory. $3,900. And then cost of goods sold, inventory. $3,900. Remove from inventory. What's this last thing? When we send it, okay, yeah, so when we send it to the government on the 15th of October, we will, remember, we have to send them $300. So there'll be a credit to cash for $300. And then we'll have that $300 come out of the sales tax payable. And let me get the board for a second, okay? So we can see that better. All right. Just a quick T of the sales tax payable account. Okay. In the first transaction, we have that $300 coming in here for the first entry. And then the third entry, when we pay it, we do the debit. And it washes out, right? Okay. So there's where we set up the liability when we make the sale. And when we pay it, we remove the liability. Okay, very easy. Okay. I think our next problem deals with... let's check it first. I think our next problem deals with interest rates again. Yeah, good stuff. Okay. Remember the formula. The formula is I equals PRT. We'll probably have to use Excel for this too, huh? So the formula is there, right? PRT. So if you're trying to calculate the interest, I, which is interest, equals PRT, principal times rate times time. All right, it says here that these are all 8%, right? So this is all 8%. I can just put an 8 in because it's got the percentages already set up. So 8. Okay. The principal is never going to change here, 160. The time is the big issue. Yeah. Okay. So yeah. Okay. Very good. So the time. Okay, the time. So it's a 90-day note. Okay, so the time for the entire it's split between 2 periods. So there's going to be a little more work to do. But if you don't worry about the periods, it's a 90-day note. So the time is going to be 90 divided by 360. And it does not do the math for us, so we'll have to do it. Let's use Excel. So principal rate, I spell time. Is this PAL? I think it's PAL, right? What does it say? Principal, yeah, like your principal at school is your pal. Who told you that nonsense, right? So it's going to equal interest essentially, right? So P times R times T is going to equal interest in this case. Kind of doing it backwards, but same thing. All right, so for the again, these are all at 8%, 0.08, like so. Like so. Here we go. Okay. Let's make these dollar bills. Let's make these percentages. Okay, now time. Now time has to be expressed in terms of years. So it starts out with what, 360. It's 90 days, right? So if I typed in here equals 90 divided by 360, it's 0.25, right? Which is a fourth, okay? So my formula here, principal times rate times time. So my interest is $3,200 for the entire note. Let's close this. I keep hitting it. 3,200. Okay, so November 7th is where we start. Let's go back to Excel. Remember, a neat thing about Excel is date math. So if I put November 7th here, and I put December 31 here, then if I did November 7th minus the 31st, it's going to be 54 days, okay? So if I find the difference of those two, it's 54 days. Okay? That's neat, right? I think it's neat. Maybe you don't think it's neat. I think it's neat. Okay? You don't like that stuff? I can't help you. You don't know what cool stuff is. That's cool. Anyway. All right? So, up until December, 54 days pass. Okay? So, if we do 90 minus 54, what's 90 minus 54? Let's see, 90 minus, I can do equal sign first. 90 minus 54. Okay. So this is going to be what? Equals, how does it listed here in the problem? Let me make sure I'm not getting, okay. Year end, okay, okay, so this is entire life of the loan, okay, to year end, and then in the next year, okay, in the next year. Let's put in next, okay. So here, remember this math here, okay. I don't want you to be confused here. This is 54 divided by 360, okay, because it's got to be out of 54 days out of 360 in the year. And then the next one will be 36 days divided by 360. Okay. So that math, okay, let's do it again. Principal times rate times time. And then again, principal times rate times time. Okay, so 1920 and then 1280. Okay, this is what, 54.36. Lovely. Not done yet, but let's go ahead and make sure we're happy there. I'm happy there, right? You should be too. Very good. Now let's make the entries. Okay, at the year end. Okay, what do we need? We need note payable. So we got cash. I've been not going to use notes payable. That's fine. Interest payable. I'm having some issues here. Okay. Let's see. Record the accrued interest expense. Okay. So at the end of the year, we need to accrue this amount right here, $19.20. Okay. It needs to be added to expense, and it needs to be added to an interest payable account. Okay. So look at my board. Okay, I've got interest payable. I've got interest expense down here. Let's go ahead and put notes payable here. I think we use it in the next one, I believe. Okay. So for the first thing, we're going to record the $19.20 in interest expense for number one. And we're going to put it into an interest payable account for number one. Okay. So that's our first entry. Let's see. Interest expense, $19.20. Interest payable. $19.20. Now, it says to record the note payment, okay? So, before we start here, remember, if you look at the problem, it says we borrowed $160,000 cash. So there's a 160 sitting right here. Okay, this will be the beginning balance. All right, beginning balance. Now, when we close the books at the end of the year, now this is a reach. Now you gotta go back to chapter 4. But when we close the books in chapter 4, this expense is closed to capital. So this will be gone at the end of the year. Okay. So this is kind of going to get closed to capital. So when we get into the new year, this is what we have. We have a liability. We have partial accrual of interest. Okay? And so now we got to do the rest of the interest and also pay this thing off. So whenever we pay it off, okay, we're going to pay the 160 plus the $3,200. Okay? So in this entry, I'm going to go down to the fourth line for number 2. The cash that we're going to pay will be $163,200. Okay, again, that is the $160,000 plus the $3,200 worth of interest that we calculated, right? So there's that. Now, I've got to remove this giant liability because I paid it off. So notes payable is a big debit of 160. Okay. 160. Which gets rid of that payable. Okay. We're also going to go ahead and pay off this liability that we've already calculated, which is last year's accrual, right? So interest payable will be removed. That's 190.20. Okay, so 190.20. Oh. Okay, that's gone. What did I say it was 163,200. And then down here we gotta do the second, those 36 days go down here, right? So those 36 days is the 120.80. The 120.80. Interest expense. There we go. So that's tough, right? We did that in chapter 9, but it was not payable, it was receivable. Okay? The same concept, different direction. Okay. Uh-oh. 120.80. Oh, I didn't. Oh, the account name was wrong. Interest expense. There we go. Now we're cooking with gas. There we go. Look at that. Okay. Good deal. All right. Number 4, payroll. Record the employee payroll for the period, okay? Let's see. No employee earned more than $7,000. Okay. So, look at employees earned salaries. Here's withholdings. Yeah, let's use our Excel spreadsheet that we've already did, right? So, we can get rid of this. Okay, we're going to get rid of all of these. Okay. Go to our problem. All right, what we got? It says here the employees earn $35,000 worth of salaries. Okay? So that's going to go in our spreadsheet right here at $35,000 of gross pay. Okay? Well, that's doing math for us, right? We'll check this in a minute. It's probably not right. So let's ignore this side of the screen for right now. Excuse me. Back to the problem. It says here, withholdings, Social Security tax is 6.2. We already did that. Perfect. FICA Medicare is 1.45%. We already did that because it's built in that formula, right? So it would be the $35,000 times 6.2 for Social Security, $35,000 times 1.45 for Medicare. Then it says $6,500 for federal income taxes. That's our withholdings. So $6,500 here. Okay. State. Oh, what's this? Medical insurance deductions. There is no mention of state, so we'll say there's no state. So we got medical insurance and then union dues. Those are both going to be voluntary, right? So those are both voluntary deductions. So we'll use state for that. We'll change it. So this will be the $772.50. $772.50. Uh-oh. $772.50. There we go. This will be health insurance. And then this will be union dues. Voluntary deductions, okay? These two here are both voluntary deductions. I didn't want to combine them. So I kept them separate, okay? Okay, so this is the gross pay. These are withholdings. Gross pay is the salary expense. These are all liabilities. Okay, these are all liabilities. Okay? And this is what comes out of the cash account. There's the cash payment to the employees. Here's the withholdings. This is the expense amount up here. All right? So, what if I can do side by side? Okay, there we go. This might be the best way to do it. All right, so payroll, salary expenses right here at the top, right? So salary expense, $35,000. Okay, then we got 1, 2, 3, 4, 5. 2, 3, 4, 5. And put cash down here. Oh. That looks like 4. I think I didn't skip enough. 1, 2, 3, 4. Good. Okay, there we go. Now, let's see if we can figure these out. So we got federal income tax, non-employment tax. Let's see. Federal income tax. This is kind of a cheap abbreviation. Employees, federal income taxes payable. That's going to be $6,500. All right. Let's see this health insurance payable. What is that? Insurance. Employee medical insurance payable. $772.50. Uses union dues payable. Okay, $120. Social Security. $2,170. And these all need to be credits. I put them in the wrong column. So good job, Mr. Cody. Those are liabilities. They all need to be credits. Right there. And our last one is Medicare. $507.50. Okay. This is not complete. So what did I forget? Oh, cash. Cash didn't come in. Oh, this is gonna. Well, they're not paying it yet. Okay, that's what it is. It's not a. It's gonna be. We're not paying it yet. We're doing the accounting for the payroll expense first. So the amount that we're going to pay is going to be $24,930, but we're going to call that salaries payable. Okay. So whenever we pay it, we'll just credit cash and debit salaries payable. So sorry, I got ahead of myself there. We are not paying cash yet. We're doing the recording the expense and liabilities. Okay, there we go. So whenever we pay it, if it said the cash, what record the cash payment, then it would be the cash to the salaries payable. Okay, very good. Okay. And is this the same question? It is not. Okay, that's fine. But we can still use this same page, this other side. Okay, this other side over here. Excuse me. Get rid of that. Okay. What does it say? 10 employees, $2,000 per month. Since January. So we got 10 employees. This is just a number, right? Not money. So number. No half employees, just 10 employees. 2,000 per month. Each earn 2,000 per month. And this is going to be January to March. So 3 months, right? So number of months. Okay. So 2,000 per employee per month for 3 months. The salaries earned by the employees will be these numbers multiplied together. 10 times 2 times 3. Okay, there we go. So $60,000 is the amount of the salaries earned. Okay, we've already got these kind of programmed in from previous. So otherwise, we would take $60,000 times 6.2, $60,000 times 1.45 percent, $60,000 times the 0.6%, and then $60,000 times the 0.54%. Okay, because those are listed out in here as well. Okay, now it says the first 7,000. If you think about it, for 3 months, each employee's made $6,000, so they're all less than that $7,000. That can get confusing. I'm just going to leave it out of this because we don't. If I was in class, I would have somewhere that was over $7,000. We're not going to do that online. So let's record the payroll tax. Okay. So these are all expenses. These are all expenses here. Okay. Well, they're payables too, right? So let's see. This payroll tax expense. Payroll tax expense is $81.90. Okay. And then we're going to have Social Security payable, $37.20. Medicare of $870. Federal unemployment taxes payable. Excuse me. And then state unemployment taxes payable, SUTA, is $32.40. Okay. That should equal out. Let's see if it works. Uh-oh. This is like any of my numbers. What did I do wrong? 10 employees. Each who earns $2,000 per month has been employed since the 1st of January. Oh, this is just March. I did 3 months instead of just 1 month. So these numbers are all wrong. So I got ahead of myself. As opposed to doing just 1 month, I did all 3 months. So I got to change this to just 1 month, right? And then there's my new numbers. So I just got a little goofy trying to do all of it. I only had to do 1 month. So let's just change the numbers, right? So payroll tax expense down there is $27.30. Okay, this is going to be $12.40. This is going to be $2.90. This will be $120. This will be $10.80. Now let's try one more time. There you go. So 1 month, not 3 months. Yeah, I did all the work instead of doing 1 month of the work. So sorry about that, right? All right. So there's that last one, right? Very good. We'll submit it. What do we get? View results. 100%. All right, anyway. So that's the quick study. So I did all in one big long video as opposed to doing two. The title says 1 of 2. I'm only going to do 1. I need to go ahead and put up I probably will come back and do some selected stuff from the Unit 5 assignment, which I didn't do last time. I'll do it this time. So Wednesday I will come on for a little while and look at parts of the video of the assignment. That's due. I got to put up a test. I'm going to try to make it quite easy this time. So we've got up until Monday. So Monday at midnight, all your stuff is due. Everything that you want to get a grade for, it's now or never. Okay. Once we finish on Monday, Tuesday morning of next week, I will put the final up. You'll have until Wednesday night at midnight to complete the final. Okay? There's no ifs, ands, or buts. It's worth a whole lot of points. I'm going to try to make it easy so you can get through it. I know it's going to be, you got 2 whole days to do it. Okay? So that's what's going to be going on here. So you've got this week to finish getting all your work in. Next Tuesday morning, might even put it out there Monday night, but next week I'll put the final out there. You have until Wednesday at midnight. On Thursday, I'm pulling grades in, giving your final grade, and we're done. Okay. So I've been pushing back dates. Now it's your turn to get it done. All right. Now, we're going to have a second question number 2 for the week. Let's see something fun. What can we do? Let's do, okay. I'm a game nerd, you guys. I play games. You guys know that. What is your favorite, girls probably don't care for this too much, but what's your favorite video game, okay? It can be a phone game. It can be, old school Miss Pac-Man. It can be, Fortnite. It can be anything. Right? Mine's World of Warcraft, right? So that's be mine. Week 5, question 2. Tell me your favorite video game. How about that? That'll be nice and easy. Guys, it's been a pleasure. I will come back on Wednesday for some for some Unit 5 assignment tips and tricks, and then we will give you some guidance on that. Put the final out Monday night or Tuesday morning. It'll be due Wednesday night at midnight, and then we'll be done, guys. So it's been a crazy semester. Hopefully you've enjoyed it. It may be hard to find a summer job because of the way it's all going right now. Maybe not. But maybe you want to consider, because it might be hard to find a summer job. Maybe you want to take a summer class so you can register for a NGU online class and keep working towards that degree. I think you can take as many as 2, right? Get a little bit ahead of yourself. Maybe it's something worth considering. Okay, so it'd be a great time to take some online computer college credit courses to get you either caught up or ahead of the game going into the fall, guys. It's been a pleasure. I'll see you on Wednesday for some more. God bless you until then.